Hi, and welcome to this video about ratio analysis for profitability ratios. I'm 𝗏𝗏𝘃𝗶𝗏, founder of Maxwell CPA Review. So the profitability ratios include the profit margin ratio and the gross profit margin ratio. And the goal is to basically see, for $1 of sales, how much do we spend on cost of goods sold, and how much do we spend on our other expenses? So how much do we keep after all of our expenses? And this video is a part of a mini video course that I have about ratios and how we analyze them, and it even includes practice questions. So if you're interested in that, you can check it out below. And with that, let's jump into the video. So then the next set of ratios are the profitability ratios. These matter because it's not enough to just look at our revenue as a company. We need to also analyze our expenses as a company, because revenue minus expenses is our profit. So that's why we have the profitability ratios. So we have two ratios here for profitability, and the first one is called profit margin. This attempts to answer, for every $1 of net sales, how much do we keep in net income? In other words, what percentage of our revenue is expenses? So earlier we said that our revenue is $102,000. Now let's say that our net income is $5,100. Therefore, our profit margin would be 5%. That means that out of everything that we sell, 5% of that becomes net income. In other words, 95% of our revenue is expenses. And then the next profitability ratio is called the gross profit margin. Here, we're not asking about our net income, we're asking about our gross profit. So for every $1 of sales, how much becomes gross profit? So then what is the difference between gross profit and net income? If we remember the basic structure of an income statement, we have revenue minus cost of goods sold equals gross profit. And then you subtract out your general and administrative expenses, which brings you to net income. So the gross profit margin ratio is only focusing on sales compared to the gross profit, and then your profit margin is focusing on net income compared to our sales. So then in our example, our sales were $102,000, our cost of goods sold was $30,600, meaning that our gross profit was $71,400. So our gross profit margin then is $71,400 divided by $102,000, 70%, meaning that we keep 70% of our revenue as gross profit. In other words, our cost of goods sold expense is 30% of our revenue. So now we know that our gross profit margin is 70% and our profit margin is 5%. So what does that mean? That means that 65% of our revenue is to pay for our general and administrative expenses. So there you have it. I hope that you've learned something new in this video. And if you're preparing for the CPA exams and you want some free weekly content, I'm sending out a free weekly email with CPA tips and articles, so you can just sign up for that at the link below. Thanks for checking out this video.